Are you ready to explore the dynamic world of finance, where fortunes are won and lost in the blink of an eye? Today, we'll uncover the secrets of private equity and venture capital, two investment types that have revolutionized the way businesses grow and thrive. Discover the strategies and success stories of daring investors who have made it to the top.
I have been a rich man and I have been a poor man, and I choose rich every fucking time.
Let's see how these investments are shaping the future of finance. What is private equity and venture capital? Private equity and venture capital are two types of investment that provide funding to companies in exchange for ownership or equity in the company. Private equity typically refers to investments made in established, mature companies that have a track record of revenue and earnings. Private equity firms acquire companies with the aim of improving their performance and increasing their value, often by implementing operational or management changes. These companies may be taken private, meaning they are no longer publicly traded on a stock exchange. Venture capital, on the other hand, typically refers to investments made in early-stage or startup companies that have high growth potential.
That had huge upside potential with very little downside risk. Does that ring a bell?
Venture capital firms may provide not only funding but also mentorship, networking opportunities, and other support to help these companies succeed. How do private equity and venture capital investments work? Private equity and venture capital firms use a variety of methods to identify potential investment opportunities, including seeking referrals, attending industry events, and leveraging their network of contacts. Extensive due diligence is then conducted on these opportunities to evaluate the company's financial health, growth potential, and overall viability. This involves reviewing financial statements, meeting with management, and analyzing market trends. Following the due diligence process, the firm determines the value of the company and negotiates the terms of the investment. This includes the amount of funding, the percentage of ownership, and the expected return on investment. Once the terms are agreed upon, the company receives funding from the private equity or venture capital firm in exchange for a share of ownership. This stake can come in the form of preferred stock, common stock, or convertible debt. The firm may also become actively involved in the management of the company, providing guidance and support to help the company grow and become more profitable. The private equity or venture capital firm typically aims to exit the investment after a few years by selling their ownership stake in the company. This exit can be achieved through an initial public offering, a sale to another company, or a management buyout. What are the differences between private equity and venture capital investments? While private equity and venture capital investments share some similarities, there are also some significant differences between the two. Private equity and venture capital investments differ in several ways. Private equity investments tend to be larger and less risky compared to venture capital investments. Private equity firms invest in companies that have demonstrated a history of success, resulting in lower risks but also lower potential returns. In contrast, venture capital firms invest smaller amounts in early-stage companies, which are riskier but have higher potential for returns. Private equity firms also have a longer investment horizon than venture capital firm. Lastly, private equity and venture capital firms differ in their exit strategies, with private equity firms usually exiting through sale to another company or a management buyout, while venture capital firms typically exit through an initial public offering. What are some of the most successful private equity and venture capital firms? Founded in 1985, Blackstone is one of the largest private equity firms in the world, with over $600 billion in assets under management. The Carlyle Group, KKR, Sequoia Capital, Accel, Andreessen Horowitz, General Atlantic, and TPG Capital are other very successful private equity and venture capital firms. These firms have made significant investments in a wide range of industries and have a history of successful investments. What are the risks associated with investing in private equity and venture capital? Investing in private equity and venture capital can be a risky venture, and investors must carefully consider the potential hazards before making an investment. Private equity and venture capital investments are often made in early-stage or established companies that are vulnerable to significant business risk, such as increasing competition, changing market conditions, and economic downturns. Moreover, these investments are typically illiquid, meaning that investors may not be able to sell their ownership stake in the company for several years, which can make it difficult to access capital when needed for other purposes. In addition, private equity and venture capital investments are typically concentrated in a small number of companies, which increases the risk of investment. If one or more of these companies performs poorly, it may have a significant impact on the overall return of the investment. There is also significant valuation risk associated with private equity and venture capital investments, as the value of the company may be challenging to determine, particularly for early-stage companies. Additionally, these investments may be subject to regulatory risks, such as changes in tax laws or regulations that may impact the investment's return. Moreover, the exit strategy for private equity and venture capital investments may not always be successful, as there may not be a buyer for the company or an IPO may not be possible. This may result in a lower return on the investment or even a loss. Lastly, the success of the investment may depend on the ability of the company's management team to execute its business plan, which is known as management risk. What are the benefits of investing in private equity and venture capital? Investing in private equity and venture capital involves taking risks, but it also presents several potential benefits for investors. Higher returns are one such benefit, as private equity and venture capital investments have the potential to yield greater returns compared to traditional investments. This potential for significant returns is particularly true for venture capital investments in early-stage companies that have a high potential for growth. Another benefit of investing in private equity and venture capital is the potential for diversification. These investments are often not correlated with traditional asset classes such as stocks or bonds, allowing investors to reduce overall portfolio risk. Active management is another feature of private equity and venture capital investments. Investment firms often work closely with company management to enhance performance and increase value. This level of involvement can give investors a sense of control over their investments, resulting in greater returns. Investing in private equity and venture capital also provides access to emerging industries and technologies not yet available through traditional investments. This access can lead to lucrative opportunities for investors. Tax benefits are also available with private equity and venture capital investments, such as lower capital gains taxes and the ability to offset losses against other gains. Finally, private equity and venture capital firms typically invest their own capital alongside that of their investors, aligning interests and increasing the likelihood of a successful investment. What are some success stories of companies that have received funding from private equity and venture capital firms? Private equity and venture capital investments have been responsible for funding numerous successful companies over the years. These firms have provided funding and support to companies with the potential for growth and success. As a result, many of these companies have gone on to achieve great success after receiving funding from private equity and venture capital firms. Some of the most successful companies that have received funding from private equity and venture capital firms include Airbnb, Uber, SpaceX, Zoom, and Stripe. These companies have received significant funding from private equity and venture capital firms and have transformed their respective industries with innovative technology and business models. Airbnb, for example, has received over $6 billion in funding from venture capital firms, including Sequoia Capital, Andreessen Horowitz, and Greylock Partners. Similarly, Uber has raised over $24 billion in funding from firms such as SoftBank, Benchmark, and GV. SpaceX has raised over $5 billion in funding from firms, including Founders Fund, Draper Fisher Jurvetson, and Valor Equity Partners. These companies serve as examples of how private equity and venture capital investments can help finance and support innovative and successful businesses, leading to the growth and development of new industries and economic benefits. What is the role of private equity and venture capital in the business world? Private equity and venture capital firms play a vital role in the business world, providing funding and support to companies with growth potential. These firms foster innovation and entrepreneurship, driving economic growth in several ways. For instance, they finance innovation by providing funding to companies developing new technologies, products, and services. This helps facilitate entrepreneurial ventures. Private equity and venture capital investments can also lead to the creation of new jobs as companies grow and expand, benefiting the economy and communities. Private equity firms often take an active role in managing their investments, providing guidance and support that ultimately improves performance and increases value. This, in turn, benefits customers, employees, and investors. Venture capital investments often target companies that are disrupting or creating new markets, transforming entire industries, and creating new opportunities for businesses and consumers. Lastly, private equity firms often acquire companies and consolidate them with others in their portfolio, aiming to increase efficiency and improve overall performance. This creates new opportunities for growth and expansion, ultimately benefiting the companies and their investors. In conclusion, private equity and venture capital firms have a significant impact on the business world, financing innovation, creating new jobs, improving operational efficiency, fostering market disruption, and facilitating acquisitions